Hello, everyone. This is Danielle Brazell Hudson, your moderator for today. I'm just hopping on to thank you for your patience. I do see that there are still individuals that are joining, so we are going to give everyone another minute or two to hop on and get settled, and then we'll start our broadcast. Thanks for your patience. Good afternoon, everyone. We're going to go ahead and get started. My name is Danielle Brazell Hudson, and I am thrilled to be here today as the moderator of our webinar, Sales Tax Audits, Turning Liabilities into Refunds. Today, our tax experts will share valuable guidance and best practice aimed at helping you reduce your tax liability while increasing savings. This is a great topic and sure to be informative, as our speakers, Tax and Trade Director Tricia Davidson and Tax Leader Sabrina Miller, bring extensive sales and use tax audit experience, having managed clients and corporate audits from nearly every U.S. state. That said, before I pass the mic over to Tricia and Sabrina, I would like to mention a few housekeeping items. Our webinar today will last approximately 1 hour, and there will be time at the end for Q&A. Any questions that we are not able to answer today will be answered via email directly to the individual asking the question. Additionally, there will be a short survey that appears on your screen after the presentation. It will be immediate, so keep a lookout for it. We ask that you please participate and let us know what other topics you would be interested in hearing about in the future. With that, let me pass the mic off to Tricia and Sabrina.
Thank you, Danny. And thank you for that introduction and for being our moderator today. And thank you, Sabrina, for presenting with me as well. And I want to say thanks as well to our viewers and listeners who are participating in this webinar. We're really excited to share with you some of our experiences as we've gone through many sales and use tax audits. And we hope that you'll find some of the tips and best practices useful. Our goal is that we inform you and provide you with the knowledge needed to understand all that's required in a state sales and use tax audit and provide tips as you focus on savings throughout the audit. Our discussion will center on what's necessary for you to do when you're notified of the audit, how to prepare, and what documentation you might need to gather and analyze in defense of your position. We'll talk about what to do with the results to ensure that you don't repeat errors that may be discovered under audit. And along the way, we'll provide useful tips and best practices that will offer you opportunities to minimize your liabilities and maximize your savings. So let's get started, Sabrina.
All right. So when you open the mail and see a letter notifying you that your company has been selected to be audited, how do you feel? What thoughts go through your mind? Have you been audited before? Do you know where to start and when or what to do? Let's go through the process at a summary level and talk about the steps to take and items to consider as you try to minimize audit liability and look for refunds. When you receive the audit notification letter that you have received from a state or locality, notice the audit period or time frame that the jurisdiction wishes to audit. You will want to know the scope of your audit so that you can ensure the auditor is working within that scope and that the audit falls within the state's statute of limitations. The statute of limitations is the period of time in which states are allowed to look back, audit, and provide an assessment on any underreported tax. It is also the period of time that you have as a taxpayer to do the opposite, to look for potential overpayments and then file a refund. Some items to consider and review upon audit notification include identifying what is the audit period covered by the audit. Is there a waiver notice included? Is a power of attorney form included for signature? What type of sampling method, if any, is indicated on the audit notice? So to start, let's discuss the audit period. This is the time frame under which the company is being audited. Liabilities and refunds will be assessed or granted for transactions identified during the audit period, which is typically 3 to 4 years. The taxpayer has the right to bring forth refund claims for the same period as the auditor is looking for liability. It's important to ensure the auditor does not look outside the audit period start and end date. Also, note that the statute of limitations only applies to taxpayers who are registered with the state to file sales tax. So if you have nexus, which is a connection to a state through people, property, or a few other factors, then you should be registered with the state to collect and remit sales tax. If you are doing business in a state and are not registered, the state can look back essentially to the beginning of time for your business, regardless of the number of years that would otherwise fall under statute. Another document which is often included as part of the audit notification is a waiver. A waiver is used when the state wants to extend the audit closure beyond the statute of limitations date. Many states typically have a 3 to 4 year statute of limitations, and it's important to note that you will need to review the statute from each state and take note of when the period starts. For example, when tax is remitted, which may not coincide with the invoice date. Now, you as the taxpayer have the choice to either agree and sign the waiver, or you can choose not to sign the waiver. Just know that if you do not sign the waiver, the auditor could submit an assessment without having the time to properly review your data and without you having the time to properly defend it. Some companies have policies on waivers, and it may be that it's a no waiver policy. They simply refuse to sign waivers, extending audits and forcing auditors to audit quickly and assess or not assess. Other companies are fine with signing waivers and using the time to conduct the audit while looking for refund potential. The key here is to know your options and weigh the risks before either course of action is taken. Also, check to ensure that the waiver will also extend the period upon which refunds may be filed, as well as liabilities assessed. Ensure the waiver goes both ways and that it's mutually beneficial. Another form that might need to be completed and may have been included in your audit notification letter packet would be the power of attorney form. These are state specific, and states will typically have their own prescribed form. Completion of this form is required for consultants or non-business members in order to represent the business and work with the state under audit. It's recommended that several individuals are listed on the form, which is valid for the tax years specified. These are individuals who are authorized to act on behalf of the company and interact or correspond with the auditor. Some jurisdictions are very particular about how these forms are completed, and sometimes they require company or officer signatures. So it's important to understand the requirements and also ensure they are completed accurately. The final area that may be addressed in the audit notification letter is sampling. If not at this point, then at some point, you will want to communicate with your auditor to confirm which type of sampling will be used in your audit, or if the auditor will audit in detail. Many times, auditors will want to get a feel for the volume of your transactions and even learn more about your business before determining whether they will audit in detail or sample or some combination thereof. There are several methods of sampling that states use under audit, and these can vary from state to state as well as auditor to auditor. So be sure you know and understand the method being used, because that will determine how many records of data that you will need to produce for the audit. Later, the method that was employed for sampling will be important when you are verifying the extrapolation of the sample to the audit period, if you're assessed for a tax underpayment. So here's our first best practice, and that is to evaluate the pros and cons of signing a waiver. Understanding the impact of making the decision to sign or not sign is an important one. Also, you want to verify the waiver extends the period in which both liabilities and refunds can be processed.
Okay, so once you've received the audit notice, you will want to begin to prepare for the audit. And you're going to want to leave yourself plenty of time, plenty of lead time to pull documents, obtain data, and reconcile returns. And often the data supporting these processes is owned by another department within your business, such as accounts payable or fixed assets. And you may need to request data or documents from these departments or their systems. So let's talk about how to prepare. You will need to do your research. Really know your company, know its activity and its presence in the state being audited. Find out how many employees you have in the state. Know where your locations are. What type of work is being conducted in the state. Really do your homework. Put yourself in the role of the auditor and investigate. Check the public information regarding your business and see what the auditor might see. Go ahead and do a search on your company. Companies may like to broadcast their presence, locations, intercompany successes, and other facts that can oftentimes be found on the internet or the company's website. An example comes to my mind when we had a company under audit in a particular state, and this company on their website stated they had a presence at a manufacturing plant in the state being audited. Now, on the surface, the auditor took this to be fact, that this entity was a large manufacturer in the state. But upon closer review, we had to differentiate between one legal entity and another who all roll up to the same parent entity. And as it turned out, the entity under audit only had a few technicians in the state at the parent entity's manufacturing facility, and they were only there for a very limited time. So information like this taken out of context could lead to wrong assumptions by the auditor, and this may in turn impact your audit. An auditor might think the entity audited had a much greater presence than they actually really do.
We recommend you talk to folks at the location, plant, or site under audit, or better yet, go there yourself for a visit. Depending on the state and your company's operations within that state, an on-site tour could be extremely valuable. It will help you understand the process flow, familiarize yourself with the equipment and operation, and may come in very useful when trying to defend your position for such things as exemptions like manufacturing and research and development. A scenario comes to mind in the case of a manufacturer and a paint machine. The specific function of the machine and its fluids came into question as to whether it qualified as exempt under the manufacturing exemption in this state. So having firsthand knowledge of the equipment and process, including photos, engineering testimony, and an understanding of how processes or equipment used may have changed during the audit period, all these things contribute to whether you can uphold your taxability position.
One other thing you'll want to do is to review any prior audits or any other open audits in other states. Find out when your company was last audited by this particular state, what time frame was audited and when, what were the results. And then ask yourself, has your company made any changes to the accounting system since then? Have there been any changes to the tax process since then? What were the major issues of the prior audit? And were they rectified by a change to a process or systems? A review of the prior audit issues will save you time in your current audit. Similarly, look at current or prior audits for your company in other states and ask the same questions. Because what you noticed in a California audit might also be happening in your Florida audit for the same audit period. Something else you might want to do is consider whether to just negotiate audit closure without doing the full audit. Now, this might be done where you've been audited several times before for a given state, and you've had audit results that have similar liabilities each time. Just think of the time and cost savings you might achieve by actually just negotiating closure and not conducting a full audit. Now, knowing answers to the above questions, your audit backlog, your risk, and the potential time spent on another audit might outweigh the burden of going through another audit that might take literally years to complete. Evaluate the value of your time versus the risk. Now, this may not be a recommendation for most businesses, but some large corporations actually do employ this tactic given certain situations. So just know that that does exist as an option for you. Probably one of the most important elements of any state sales and use tax audit as you begin to prepare is to know what is exempt and what is not taxable. Listed on your screen are some of the most common exemptions, but know that there are many other exemptions in the sales tax world, and they do vary by state. So it's important for you to research all the applicable exemptions during the audit period and evaluate whether your company was qualified for such exemptions. Determine which exemptions were applied and how you will defend them. Again, become an expert on the state sales and use tax laws and regulations. This brings us to our second best practice, and it's really simple. It's do your homework and be sure that you know more than the auditor will know about your business, the types of transactions you have, your data, your customers, and your exemptions.
All right, so now let's consider what documentation may be needed, whether it be paper documents, electronic files, or other items. Ensuring you have the right documentation will put you in a good position for supporting any refund claims or defending any potential liabilities. You may have noticed on the audit notification letter that the auditor requested a long list of items. This list is often quite extensive, and most include a request for federal and state income tax returns. Consider first if it makes sense for you to provide these. For most large corporations, they likely will not tie out to your specific business entity being audited because these businesses or entities roll up to a parent company. If it doesn't make sense to provide the information, then why do so? You will want to explain this to the auditor in an email or perhaps on a conference call. Additionally, auditors should already have a copy of the state sales and use tax returns, but some auditors will still request them regardless. So be prepared to pull the state sales and use tax returns filed during the audit period and provide either hard copies or electronic copies to the auditor. Ensure you have included both originally filed and any amended returns. In addition, know whether your company has filed refund claims for data during the audit period so that you are aware of this in advance, can include it in your reconciliation, and so you don't duplicate any refund requests. You really should always try to be a step ahead of the auditor. Do what the auditor would do before sharing your data, and check the auditor's work. Before you provide the supporting sales and purchases data, along with the sales and use tax returns to the auditor, take the time to go through and reconcile each and every month of the data to the returns, accounting for any variances or adjustments and credits, and be prepared to discuss this with the auditor. You will want to know the returns tie out to your sales and use tax data before providing them to the auditor. The auditor will also follow the same process. You will want to know what to expect before finding it out from your auditor. Also, compare the supporting data not only to what was on the returns, but also to the balances of the applicable general ledger accounts for each period. Again, reconcile any variances. And really, this is critical. Auditors will often assess based on general ledger balances unless information is provided to prove otherwise. So proactive companies are actually doing this process each month as part of the return preparation process. Each month, the applicable general ledger accounts are reconciled. You can kind of think of it this way. You know how hard it is to recall something that you did or said years after the fact? Well, you really don't want to be in that position with the audit. If you don't currently have a process in place for account reconciliation, we recommend you set one up now to avoid potential liabilities. Now, if you recall, we previously spoke of sampling earlier on in the process. Depending on the type of sample and period, you will need to obtain the requested data. Keep in mind that certain months may historically or typically have higher volumes compared to other months. So for example, if your business is cyclical and historically experiences peak volumes in sales in April, then April is not a fair representation of your sales volume. Another area to consider is when system changes may have occurred during the audit period. You may not want to use that month in your sample. Consider your business and identify if there are any other outliers, such as large purchases, that may impact specific months within your audit period. What you want to do here is really select a month with normalized volumes and activity. Don't just push paper by getting the data requested and providing it to the auditor. Do your own auditing first and really know what the auditor will know before you share your data and documents.
So let's break down the audit data elements into two portions. Let's look at sales data and purchases data. And within sales, let's address taxable sales and exempt sales separately. And within purchases, let's discuss expenses and fixed assets. For sales data, specifically taxable sales, you'll first obtain the sales data reports for the given period. You'll pull the invoices to see if the ship to is the same as the state of audit. Many times, instead of the sales data capturing the ship to party, it captures the sold to party, which could be an entirely different state and would be outside the scope of your audit. And we've seen this oftentimes when a company may use the corporate headquarters as the sold to party, and sometimes that gets populated as the ship to state. The same applies for the invoice date. Make sure that invoice dates are within the scope of your audit period. Next, you'll want to see if the state had any rate changes within the audit period and compare this to the invoices and data. Calculate the tax that should have been invoiced. This may highlight any transactions in which tax was over or understated. This is one area where you could seek a refund on tax that was overpaid due to incorrect rates. The auditor will also compare the taxes collected to the taxable amount per invoice to confirm the rate used was correct. And the auditor will look for line items on the invoice that do not reflect any tax and may ask you to verify why no tax was charged, or they may simply assess you on these items. Evaluate these non-taxable items and prove why no tax was charged on these items or to these companies. Now you have an opportunity here to look for transactions where your company charged sales tax to a customer who should have been exempt or on a product that was non-taxable. And in these cases, you can request a refund of the taxes charged. if proper documentation is obtained substantiating it. This leads us to exempt sales. For exempt sales, you'll review invoices and exemption certificates. When going through an audit, you'll typically see 4 types of invoices: those which are fully taxable, fully non-taxable, exempt, and partially taxable. And as we just mentioned, for either line items where no tax was invoiced or entire invoices where no tax was charged, you will need to defend these transactions in audit. And to do so, you may need to provide proper supporting documentation such as exemption certificates, resale certificates, statutory support of non-taxability, or any other means of documents indicating the items were exported from the state or otherwise not taxable or exempt, or perhaps tax was paid by the purchaser. This is a very important area where companies often incur the greatest tax liability under audit, and it's an area where you can achieve sizable reductions if you can provide proper documentation. A good process to follow routinely is to identify all exempt customers, customers for which no tax was charged on the invoice. Next, compare that list of exempt customers to the exemption certificates you located for the audit period and state. Identify any gaps, any certificate not found for a given customer. Missing certificates should be requested from customers, which can sometimes present a challenge. We've seen many cases where customers are no longer in business or cannot be contacted, and certificates are just no longer available. Now, this is an area where many businesses incur a tax liability through audit, and it really could be avoided. Lack of valid exemption certificates can result in substantial assessments. And it's really interesting because it's such a seemingly simple process or routine that could be implemented and could avoid tax liabilities down the road. Ideally, if exemption certificates were collected and validated at the time of the transaction at the point of sale, then significant liabilities in this area could be minimized. I can't stress enough the importance of maintaining valid exemption certificates. If a taxpayer is unable to provide a valid certificate, then the auditor will deem the transaction taxable and an assessment will be forthcoming. So let's say you're missing a certificate for an exempt customer and you've reached out to them. An alternate option, what you might be able to do is to request what's called an XYZ letter. And an XYZ letter is just a form or a letter which states that the purchaser has accrued and remitted use tax directly to the state on this transaction. Now, this may occur when the seller did not charge tax, but the purchaser deemed it to be taxable, and the purchaser then self-accrued and remitted the use tax to the state. You want to make sure you check the state statute for the required format or the content of an acceptable XYZ letter, as it may vary by jurisdiction. Now, I want to spend a little bit more time on exemption certificate storage in particular. It's critical that supporting documents such as exemption certificates are valid and applicable to the audit period and jurisdiction. Often, the task of identifying the location alone of the certificates can be challenging for some companies. And believe it or not, some companies still maintain their exemption certificates in hard copy fashion in a filing cabinet. Finding the location of these papers can be time consuming, and the organization may be in disarray. Optionally, they may be stored electronically in a repository system to which you may or may not have access. Exemption certificate format varies by state. Some are issued by the states once, annually, or otherwise, and others are forms that the customer provides to the seller. In addition to ensuring the appropriate form is provided, it's important to ensure that it's signed, dated, complete, and accurate, and that you have one for every exempt customer, as well as a process to collect and validate them. Ideally, they are stored electronically and indexed so that a user can quickly find what is being sought, and they are preferably accessible remotely. Using a proven process and an automated system to manage exemption certificates can significantly reduce not only the time you spend on audits, but also your potential tax liabilities. So you may be wondering, what makes an exemption certificate valid? Well, we've listed those items here for you, and we'll take a look at them. Seller's name and address, customer's name and address, customer state registration number, customer signature and date, effective date of certificate, a description of the items or services purchased, and a valid reason why the items or services purchased are exempt. And finally, a description of the customer's type of business. And these are the basic required elements, but know that they do vary state to state. It's a best practice to obtain completed and valid certificates at the time of purchase so they can be stored electronically and readily available when needed for audit. So we've reviewed our sales data, and now we'll take a look at our purchases data. Purchases will often include transactions made by a taxpayer based on a purchase order or with a corporate credit card, and they will include expense items as well as capitalized assets. Now, auditors may request purchases data in various forms, such as from accounts payable reports or the detail for specific or certain general ledger accounts. Purchases may be audited in detail with a review of every line item, or they could be sampled. It depends on what you and the auditor have agreed to early on in the audit. Regardless, it's important that for any invoices on which taxable items were purchased and tax was not accrued and remitted, that an explanation be provided in audit. Check invoices to see if tax was charged and paid to the vendor. Check use tax reports to see if you have self-accrued when tax was not paid to the vendor. And look for errors that may be in your favor. Conducting what is called a reverse audit or an overpayment review of purchases could be a huge potential to offset liabilities. The auditor is looking for tax due, and you do the opposite. You look for tax that might be overpaid. Now, a few areas to review that you might want to take a look at would be tax paid on invoices, but the product was shipped to an out-of-state location not within your audit, possibly electronically delivered software in certain states, tax inappropriately accrued or accrued to the wrong state, tax paid on non-taxable items, exemptions such as manufacturing, research and development, IT, utility usage, manufacturing partial exemption. And then my favorite is where tax is paid to a vendor and self-accrued. And these are just to name a few areas that you can look for in an overpayment review. But knowing what exemptions your state allows will help you search for overpayments. And exemptions will vary by state. And again, they may be fully or partially exempt. But we found this particular area here to be one of the biggest areas of opportunities for taxpayers. And this is where you'll see how strong your tax accrual and review process is. And you'll see how accounts payable is coding invoices in your purchasing software. And you'll see how your buyers are coding purchases as taxable or not. A very detailed analysis needs to be completed on your purchases. And this is where you can find sizable savings that could offset or even exceed any audit liability. Now, many taxpayers don't have the personnel, the tax knowledge, or the time to devote to such an exercise. And for many, just getting through the audit and waiting to see what the auditor finds is how they consider being audited. But flip that decision to act, to do something about the potential that lies in the taxability of your purchases. We've seen taxpayers who, as a practice, only rely on what the vendor charges for sales tax and do not have an accrual process. These taxpayers are going to have a use tax liability under audit. And alternatively, we've seen taxpayers who, as a practice, self-accrue on everything if tax was not charged by the vendor. And in some cases, regardless of whether tax was charged, they might accrue as well. Now, these taxpayers are leaving money on the table when audited because they're overpaying tax. And then when the statute of limitation expires, they're out of luck. So if your company's looking for cash, and most companies are, get the help you need. Look here. Conduct what's called a reverse audit. And if your company doesn't have the staff, expertise, or time to do so, there are plenty of consultants out there and companies in the market who can help you. And many will even conduct the review for a limited fee or even a contingency fee only. So really, it's a win-win situation for both the taxpayer and the consultant. So when you've completed your reverse audit and your review of purchases, you may find that you need to file a refund claim. So you'll compile your overpayments and supporting documents. And it's really important to note that when you find these overpayments, you determine how to file the refund claim in the given state. And make sure you go through the proper channels with the correct forms with the state or jurisdiction. Now, oftentimes you'll work with the auditor who's assigned to you on your audit for the refund claim. But just know that in some particular states, you may need to file or submit the refund claim initially with another area within the state or a different department. So it's important to know the proper order for filing the refund claim itself. So this brings us to our third best practice, which is to use the open audit as an opportunity to search for potential overpayments of both purchases and sales and turn tax due into refunds. And focus on those areas we spoke of in particular. Examine your company's exemption certificates and the process for obtaining and storing them, and perform a use tax review of purchases or a reverse audit.
Okay, so now we're going to discuss how to go about defending your tax position. As you go through the audit process and work with the auditor, you will need to closely review the findings that the auditor has identified and proposed. The final audit findings are presented in a report and are commonly referred to as audit work papers. Your options here are to either acknowledge they are correct and indicate you agree with them, or you can let the auditor know that you disagree. However, if you disagree with any item on the work papers, clearly indicate which items and why, and explain this to your auditor. You will need to prove your case as the burden falls on the taxpayer. You may need statutory references, rulings, or additional documentation to support your position. This is also the time to review the sampling method the auditor employed during the audit and ensure it's correct. Run the numbers and compare them to the auditors. If you don't know how an auditor arrived at a value, ask and get clarity. This is really your last chance to resolve any issues with the auditor before the audit is closed and an assessment is issued. So you want to ensure all remedies have been attempted. It's often much easier to resolve issues and disagreements with the auditor directly while the audit is still open. Once the audit is closed, an appeal would need to be filed to protest any part of the audit assessment. So take the opportunity to prepare your defense and share it with the auditor on any gray areas. Build your case by reviewing prior rulings and cases for similar audit issues and outcomes. Compare your situation to similar ones and identify cases supporting your position. You really want to discuss your position with the auditor after providing the supporting documentation and work with them to clarify any misunderstandings regarding your products or processes and try to reach an agreement. In this area, you really might need to pick your battles. Know what issues are most greatly impact you and identify those that are most important to you. So then at the conclusion of the audit, the notice of audit findings will be provided by the auditor summarizing the audit and identifying any areas of tax liability or refund. In advance of your receipt of this report, however, you really should have already gotten an estimate on the expected tax refund or liability because you've been managing the audit throughout the entire process. Now, if there's still any parts of the auditor's findings that you disagree with after reviewing the final audit notice, then you should consider whether or not to appeal the audit. Some important things to consider include, what is the likelihood of winning an appeal? What is the cost of an appeal? And what do you have to lose, as well as what do you have to gain? So if you do choose to appeal, be sure to file the required paperwork and supporting documentation as the state prescribes and do so timely and accurately. Please note too, this process will vary by state. So if not done correctly or timely, you could lose your right to appeal and then have no recourse. So carefully review the appeal process and really know what to expect. This leads us to best practice number 4, which is to do a detailed review of the audit findings, including the calculations, tax rates, and the sampling method. Your best shot at obtaining the outcome you want is to try to resolve any issues directly with the auditor before the audit is closed.
Okay, so your audit is in the final stages and it's ready to be closed. What's next for you? What do you do? What will you do with the audit findings, the results? So as Sabrina just mentioned, you'll receive a summary of audit findings when the audit closes. And this is the result of the work papers that you and the auditor worked on throughout the course of the audit. This will outline the tax underpaid as well as the areas where the tax was underpaid. It's really important that you're sure to fully understand all of the audit findings. If there's any questions, ask the auditor. Determine the root cause that led to the tax errors that either resulted in an overpayment or an underpayment. And also verify the auditor's findings, especially the calculations and the tax rates. The auditor can make mistakes. We've seen this happen time and again, so double check the work of the auditor. Also check the reference regulations and statutes to ensure that all were correctly applied to your situation in your state. With your audit results, you'll want to improve your tax process. So from the issues identified during audit, identify those that contributed to the liability or the refund, and identify the drivers behind the issues. What is the root cause? And take some time to summarize the findings in your own words and do a write-up. This will be very beneficial the next time your company is audited. It can provide you with a background on the prior audit and the issues encountered, and it can prepare you for future audits. And you have the time right now to correct the problems you found, so you're not destined to repeat the same mistakes in the future. If your audit resulted in underpayments, it could be that your tax rates in your system are not accurate, or you may have invoice entry issues. For example, your ship to state is not being entered, or the wrong state is used. You may have issues with obtaining and maintaining customer documentation for exempt sales. We talked about exemption certificates. If your audit resulted in overpayments and you don't want to continue to overpay them, and who would, you don't want to lose access to that cash for your company, take the time right now, find the problem, fix it, mitigate those risks, and reduce those over and underpayments. So essentially, you want to improve your tax process and your audit process, both in effect. So what solutions will you employ? Well, for processes, ensure standards are established. You should have standard operating procedures, SOPs. Have routines. Make sure routines and protocol are both followed. Taxability references or resources who you can go to. Make sure you've identified them and they're available to you. And this is a really good opportunity to either update or create what a lot of companies call a buyer's guide or a taxability matrix. It's specific to your company and to the state you do business in. It's also a good time to train the purchasers and buyers in your company on some degree of the tax and its impact. Let them know the impact of tax on an improper tax decision. For example, that machine that was coded improperly, it resulted in tax due an audit of $4,500, but it would have only been $450 in tax at the time of purchase had it been coded correctly. So things tend to accumulate over the course of the audit. So it's better to fix a mistake and avoid it before it actually happens in an audit. For systems, verify tax rates, customer exemptions and statuses, and ensure product and state taxability are up to date in your systems. And then implement the solutions to the problems and make sure you stay in control of your tax burden. Test the implemented solution periodically. Make sure effective controls are in place and that they're working. And our fifth and last best practice is to ensure updated processes and systems are in place based on your audit findings. And this will help you reduce future liabilities. And give really close attention to the areas of exemption certificate management and use tax accruals on purchases. These are both really big opportunities and good areas where you can find savings.
So to summarize, here are the 5 industry best practices we have provided throughout the presentation today. First, you want to evaluate the pros and cons of signing a waiver and ensure it will also extend the period upon which refunds may be filed as well as liabilities assessed. Second, do your homework. Know more than the auditor will know about your business, transactions, data, and exemptions. Third, use the open audit as an opportunity to search for potential overpayments and turn tax due into tax refunds. Fourth, verify the audit findings, numbers, the sampling method, and tax liability calculations. Work to resolve any issues directly with the auditor. And fifth, ensure updated processes and systems are in place to reduce future audit liabilities, exemption certificate management, and use tax accruals on purchases, as these are big opportunity areas.
So in conclusion, we hope that your perspective on audits may also be that you see audits as opportunities. And yes, they can be quite painful to go through, or they can be fairly straightforward. Either way, the occurrence of audits resulting in liabilities can be minimized when an audit is properly managed. Liabilities can be flipped to refunds provided you utilize the proper resources and processes. So to review, look at these 3 primary areas as you focus on refunds of sales tax: incorrect tax rates, missing or invalid exemption certificates, tax charged on non-taxable or exempt transactions. And look at these 3 main areas as you focus on refunds of tax on the purchases side: use tax accrued and tax paid to vendors, tax paid on non-taxable or exempt purchases, and tax paid to estate in error.
Okay, thank you, Sabrina and Trisha. That was great. Lots of good information in there. So now, before we wrap up, we're going to take a few minutes to answer some questions that we are going to receive from all of you out there who have been listening. So I'm going to pause for a minute here to allow you guys to collect your thoughts and to put those questions into some words here. You should be able to post your questions through the system. So I'll pause and then we'll get started here. Okay, ladies, we have one. What is the average length of an audit from the time of notification to completion?
Well, I can say we've seen audits concluded in as little as a few weeks, but also some that have gone a couple years. Something that can contribute to that is if you have a location or a headquarters in the state or jurisdiction being audited, sometimes it can be a little longer.
Okay. All right, it looks like there's another question here along a similar vein. What is the frequency of communication with the auditor?
Well, there really is no set requirement, but I mean, obviously you want to be professional and you want to be responsive. Audits can tend to drag on, so you want to do everything in your power to make sure that you are obtaining the data and the documents the auditors requested, and you're providing them to the auditor on a timely basis. Let the auditor know if you run into any obstacles or setbacks that might delay your response. But the same token, an audit could go on for a period of months or years. You want to make sure that you are being proactive and following up, I would say, on a weekly basis with an auditor and continuing to ensure that movement is happening with your audit. It's really in your best interest, because if you think about it, you know, the audit goes on for months or years, your tax liability is out there, plus your interest keeps accruing week after week and month after month. And it's really in your best interest to shorten that audit cycle and to get it wrapped up as soon as possible. So push things along, speed things along as fast as you can from your side, and work with the auditor and be responsive and stay in touch.
Okay, thank you. Okay, here's a question that I actually have as well. So me and this person are on the same page, it seems. Is it better to appeal or to work it out with the auditor?
Well, it's actually better whenever you get the chance to work it out directly with the auditor while the audit is still open. The auditor has really greater flexibility to work with you, and you're more likely to receive the outcome that you're looking for rather than under appeal.
Okay, here's a good basic one, I think, for you ladies. What is use tax?
All right, so you've heard us reference sales and use tax, and essentially they're the same thing. The sales tax and the use tax are complementary to each other. It's basically the same thing, just different terminology. Typically, we use the term sales tax when it's a tax on a transaction, a sale. In terms of the use tax, perhaps a vendor did not charge sales tax to you when you bought something and you realize that it's taxable. What you would do is you would accrue, or you would remit to a state what's called use tax, because you're the user or the consumer. So essentially, sales and use tax are the same thing, just different words, and it depends on, who the remitter is.
Okay, I see that we're getting a lot of questions, y'all. So I'm just trying to keep up here. All right. Let me see. Can more than one waiver be issued during an audit?
Yes, definitely. And it depends on your audit and your auditor and your ability to continue to sign waivers. Remember that we said you always have the option to agree to a waiver. It's in your court. So an auditor might find that he needs more time or she needs more time to conclude the audit, and the statute's running about to expire, so they need more time. So they might ask for another waiver. You might have 1, 2, 3 waivers in the given course of your audit cycle time, and it's fine to have that many. It's really up to you as to how long you want to continue things to go along. And maybe you actually need the time to go get the data and the documents that's required. So it's pretty customary to see more than one waiver. Obviously, after so many times, it kind of gets to be a little frustrating and you want things to end. And you always have the option to say, no, we're not going to sign waivers. We're done. Let's move on.
Okay.
Okay, so we've got a few more questions. If an item is taxable, but the customer claims resale, how do we get the requested information from the customer, or do we just take their word for it? They will resell it. Great question. So a few things going on here, right? An item's typically taxable, but the customer says they're going to resell it. Well, when you accept an exemption certificate, you accept it in good faith, and that means you're reasonably certain that the person giving it to you is going to do what they're going to say they're going to do, right? So if you accept a resale certificate from somebody who does not seem to be in the business of reselling, let's say they're a reseller of office supplies and they are buying a piece of construction machinery, they're not really engaged in the business of reselling the construction machinery. So it kind of seems suspicious to me as a seller to accept that in good faith. So I would always want to question that company, maybe do a little research in terms of what kind of business are they in? Does this make sense? So, use your due diligence. Make sure you've kind of exhausted your responsibilities in terms of checking out the customer and kind of what business they're in. Is the certificate filled out properly? Is it the right form? Is it signed? Is it dated? And they should list on there, they're going to resell it. And, you have every right to talk to them and to question that. So, but in the end, know that, depending on the state you're in, if something comes through in an audit and that tax liability could be on you as a seller. So you really want to make sure that you do your due diligence, when in doubt, talk it out or see a consultant. Okay, another good question. Can we waive the interest on the assessment if the auditor is delaying the final assessment? Great question. Had a lot of experience in sales and use tax audits. Unfortunately, many times you're kind of at the mercy, if you will, of the auditor's timeline as well as your timeline. And along the way, like we said earlier, we want to try to move things along and speed things up. I have seen many cases where the penalty has been waived However, interest is a much harder thing to get waived or reduced. Now, I would presume if you had enough, evidence or documentation of delays on their side versus your side, it would definitely be worth appealing or trying to get a reconciliation on.
All right, Trish, I have one more question from my side. What is the difference between exempt and non-taxable?
Okay, great question. And we talked about those different terms in our presentation today. So basically, something is non-taxable if the state's laws, the statutes, don't prescribe it as being taxable. Whereas something is exempt if it's typically a taxable item, but the use of it or your organization, your company, lends itself to be exempt. And an example is this. Let's say you're buying a machine, right? It's tangible personal property. It's typically taxable in every state that has a sales tax. But in this case, it's exempt because you are a manufacturer and you're in a state that has a manufacturing exemption. So in this case, that machine is exempt versus non-taxable.
Okay, I'm taking a look at the clock, and in the interest of time, I see we still have about 4 minutes left, but so that we keep everyone on schedule with the rest of your day, I'm going to go ahead and wrap up. If we have not answered your question, we received a lot of great questions today. Please know that our tax analysts here are going to take a look at those questions, and we will get back to you. So thank you again, all of you, for joining us today. We really appreciate your interaction and great questions. If we can be of service, you can please reach out to us at tax@allenintel.com or reach out directly to Tricia or Sabrina. You see them in their beautiful pictures on the screen there in front of you. Also know, if you are interested in custom training on this topic or any others for your company, let us know and we can arrange it. I encourage you also, if I can make a plug, to visit our website for our publications and content at allenintel.com and check out our new podcast for tax content. And please also check out the content for our other poles of the business. We have transportation management as well as trade compliance consulting as well as pieces of our business. And we have a lot of great publications and content on our website there as well. So thank you very much and have a great rest of your day.